Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 142, titled The Poor Man's Covered Call, Explaining Upside Potential. We're going to be using a real-life example with Intel Corp, which trades on the NASDAQ exchange under the ticker symbol INTC. Let's start by defining the strategy, the Poor Man's Covered Call, or PMCC. Now, this is a covered call writing-like strategy where leaps options are used instead of actually buying the stock or the exchange-traded fund. When we buy a leaps option, we are buying the right but not the obligation to buy the shares at the strike price by the expiration date. Now, typically, the leaps we select are deep in the money, so we have the opportunity to purchase the shares at a much lower price than they're currently trading for, expiring 1 to 2 years out. That's what makes them leaps options. They're long-term equity anticipation securities. Now, deep in the money leaps have deltas that approach 1, which means that for every dollar change in the price of the stock, the leaps option will change by a similar amount. So if a leaps option has a delta of 95, if the stock price changes by $1, the leaps option will change in value by 95 cents. So the leaps options we select will have deltas, let's say, above 75. Now we're going to turn to a real-life example with Intel. On 5/18/2020, Intel was trading at $58.30. That was the market price of Intel per share on that date. Now, the January 21st, 2022, so more than a year and a half out, the 35 deep in the money leaps option had an ask price of $25.55. So instead of paying $58.30 for a share of Intel, we'd be paying $25.55 for the right but not the obligation to purchase Intel at the strike price of $35. Now, also on May 18th, 2020, the $60 1 month out of the money short call, so higher than current market value of $58.30, that short call strike 1 month out had a bid price of $1.75. So if we had a covered call on Intel at that point in time, that's the amount of cash that $60 strike 1 month out would generate, $175 for the contract. Now, you're looking at a screenshot now for those of you who are watching the podcast. For those who are just listening, I will describe it. But the BCI Poor Man's Covered Call Calculator has an initial trade execution tab number 1, where on the top in the blue areas with white cells adjacent to it, we type in the information gleaned from the option chain, which I just described to you. So we type in the ticker symbol INTC. The trade date is 5/18/20. The short call expiration date 1 month out is 6/19/20. The price of the stock at the time the trade was entered was $58.30, and the strike on the leaps option, deep in the money, long-term expiration, a year and a half out, 35 strike. The cost of the leaps, $25.55, with an expiration date of 1/21/22. Now, the short call strike, remember, was higher than current market value of $58.30, and that strike was $60. So it's an out-of-the-money strike for the short call. And that bid price that we would generate, the cash we would generate by selling that 60 short call, is $1.75 per share. Now, once that information is entered into the top portion of the spreadsheet, the calculations will appear below it in the green cells. So we find out that this is a 32-day trade based on the information we entered. And the actual result, if we close both legs of the trade, if the price, let's say, accelerated dramatically and we were forced to close both legs of the trade, we will have generated $1.20 per share, $120 per contract. The return on the short call, the way it's initially set up, is 6.85%, but we can actually generate an additional 6.65% if Intel went from current market value of 58 and change up to that 60 strike. So the potential total 1-month return with premium and share appreciation is actually 13.5%, and the actual initial return would annualize out to 154%. So big numbers for this strategy because the cost basis is much lower than if we purchased the shares as stock or ETF, as opposed to the leaps corresponding leaps strike. Now, there are many components to the poor man's covered call strategy, so there are pros and cons. It's not simply covered call writing, but cheaper. So you have to master all aspects of this strategy before making a determination as to whether or not it's right for you and your family. And we have information on that in our book, Covered Call Writing Alternative Strategies. We have an online video program for this strategy, as well as this PMCC calculator that I'm alluding to in this video. So you have that information there. Now, the initial 30-day time value return, as I said, was 6.85%. And we have a possibility of an additional 6.65% if Intel went up to that 60 strike. That's really the takeaway of this particular calculation. So this is what we mean by upside potential, and we can benefit from it actually in two ways as it applies to this PMCC strategy. First, from share appreciation, it will enhance the value of our long leaps position. That upside potential, as the price of the stock goes up, the value of our long leaps position will also go up. Also, if the option is not exercised or rolled out and up, we'll create a situation where we can actually sell a higher strike short call. So if the price of Intel goes up from the original 58 and change price, then the next short call we sell can be higher than that 60 strike. And what that does is it increases the width of that bid-ask spread. And that means we can benefit financially by buying at that same 35 strike, but ultimately selling at a much higher strike. So that is where the upside potential plays in with the PMCC strategy. Before I go, I want to make you aware of a couple of products available, which includes this PMCC strategy. First, our BCI package, an acronym for our best and most comprehensive investment package ever offered by the blue-collar investor. And that is available on our website. It includes 6 online video courses, 6 calculators, 5 books in ebook format, including our bestsellers, and 13 months of a premium membership, which has actually over 200 components to it. Now, I also want to make you aware of a more recent trade management calculator package, and we have created a one-of-a-kind spreadsheet where you can enter all your covered call writing and put selling trades, get your initial returns. Then you'll have a management section. We have over 20 different exit strategy choices, and get your final returns per trade or per total portfolio. The package also includes my 8th book, which was published in June of 2022, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, and that book comes as a PDF attachment along with the calculator and the user guide for the TMC calculator. Just go to our website, thebluecollarinvestor.com. Click on the link at the top that says Best Discounted Packages. You can also go to our store, thebluecollarinvestor.com/store, and you can purchase these items individually. Ladies and gentlemen, that ends this BCI podcast number 142, The Poor Man's Covered Call, explaining upside potential. I hope, folks, that you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, This is Alan Ellman, the Blue Collar Investor. Take care, everybody.